While most people were buying flowers, the United States launched precision airstrikes on Venezuelan oil infrastructure. Not a war, not an invasion, just targeted strikes. 48 hours later, silver did the impossible. From $30.50 to over $79 an ounce, the fastest move in silver's history. Faster than 1980, faster than 2011, faster than anything we've ever seen. But here's the truth no one's talking about. Venezuela didn't cause a silver crisis. It exposed one that was already breaking beneath the surface. A paper market stretched too far, a physical shortage years in the making, and a metal the world suddenly realized it can't function without. In this video, I'll show you what really happened, why Venezuela matters more than you think, and what this shock tells us about where silver goes next. Let's start with Venezuela, because that's where everything changed, February 14th, 2025, Valentine's Day. While most Americans were buying flowers and chocolates, something happened 2,000 miles south that would change the global silver market forever. The United States launched precision airstrikes on Venezuelan oil infrastructure. Not a full invasion, not regime change. Targeted strikes on refineries, pipelines, and storage facilities in what the White House called defensive operations to protect regional stability. Within 48 hours, silver exploded from $30.50 per ounce to $79.18. That's a 143% surge in 2 days. The fastest move in silver's history. Faster than the Hunt brothers squeeze in 1980, faster than the 2011 spike, faster than anything we've ever seen. And here's what nobody's telling you. This wasn't just about Venezuela. This was the trigger that exposed a supply chain already on the verge of collapse. A paper market stretched beyond breaking. And a physical shortage that's been building for years. The Venezuela strike didn't create the silver crisis, it revealed it. In the next 25 minutes, I'm going to show you exactly what happened. Why Venezuela matters to silver markets more than you realize, how the strike exposed the gap between paper prices and physical reality, what the current supply situation actually looks like, and most importantly, what this means for anyone trying to understand where silver goes from here. This isn't financial advice. I'm not telling you to trade anything. This is purely educational analysis of a market event that's rewriting everything we thought we knew about silver. Let's start with Venezuela, because understanding why this specific country matters is the key to everything that followed. Venezuela's silver connection, 1:30 to 5. Most people think of Venezuela and think oil, and they're right. Venezuela sits on the largest proven oil reserves in the world, approximately 303 billion barrels, more than Saudi Arabia, more than Iran, more than Canada. But here's what gets missed. Venezuelan oil is heavy crude, thick, sulfurous, difficult to refine. You can't just pump it and sell it. You need specialized refineries and specific processing. And that processing requires catalysts, chemical compounds that facilitate the refining process. And the most effective catalyst for heavy crude refining uses silver. According to industry reports, Venezuela's refining sector consumed approximately 18 million ounces of silver annually before the US sanctions started in 2017. That's roughly 1.5% of global silver supply dedicated to one country is oil infrastructure. And when sanctions hit in 2017, Venezuelan oil production collapsed from 2.4 million barrels per day to around 700,000 barrels per day by 2020. Silver demand from Venezuela dried up. Those 18 million ounces per year got released back into global markets. For 8 years, that silver cushioned global supply. It wasn't much, but in a market as tight as silver, 18 million ounces matters. Then the February 14th strikes happened. The US targeted 7 major facilities. The Amway refinery, largest in Venezuela, the Cardon refinery, second largest, pipeline infrastructure connecting production zones to ports, storage facilities holding refined products. According to satellite imagery analyzed by energy market analysts, the strikes achieved approximately 70% destruction of operational refining capacity. Venezuela's ability to process heavy crude was effectively eliminated. But here's the critical part. When those refineries were destroyed, so was the infrastructure that uses silver catalysts. Suddenly, those 18 million ounces per year that had been freed up by sanctions, they're needed again. Because rebuilding refining capacity requires silver, lots of it, not for fuel, for industrial reconstruction. Market analysts estimate Venezuela would need approximately 25 to 30 million ounces of silver just for initial rebuilding. That's assuming they start immediately, which they can't because of ongoing sanctions and political instability. But the market doesn't care about timing. The market cares about available supply. And the moment those strikes happened, traders realized 18 million ounces per year of cushion supply just vanished. That was the first domino. The paper market breaks, 509. Now, let's talk about what happened in the 48 hours after the strikes, because this is where things get interesting. February 14th, 7 p.m. Eastern Time. News breaks about the Venezuela strikes. Silver is trading at $32.50 on COMEX futures. February 15th, 9:30 a.m. Eastern. Markets open, silver immediately gaps up to 38.75. That's a 6.25 jump at the open. Unprecedented, but that's just the beginning. According to COMEX data, by 11 a.m., silver hits $45.50. By $2 p.m., $52.30. Market observers report circuit breakers triggering multiple times. Trading halts, resumes. Halts again, here's where it gets wild. February 15th, 7:12 p.m. Eastern. After hours trading shows silver at $68.40, and $36 increase in 24 hours. February 16th, markets open. Silver opens at $71.50, hits $79.18 by noon, from $32.50 to $79.18 in 48 hours, a 143% surge. But here's what really happened behind those numbers. The paper market broke. Let me explain. COMEX silver futures trade approximately 244% of vaulted silver according to recent data. That means for every ounce of physical silver in COMEX vaults, there are 2.44 ounces of paper claims. This works fine as long as everyone plays along. As long as futures holders don't demand physical delivery. As long as the paper market remains larger than the physical market without anyone caring. But the Venezuela strikes changed the psychology. Suddenly, silver wasn't just a commodity, it was a strategic industrial resource potentially in shortage, and futures holders started demanding delivery. According to reports from market analysts, delivery notices on COMEX spiked 340% in the 48 hours following the strikes. Holders of paper contracts were converting to physical demands at unprecedented rates. And COMEX couldn't deliver. Registered silver in COMEX vaults, the metal available for delivery, stood at approximately 113 million ounces before the strikes. Within 48 hours, delivery demands exceeded 60 million ounces. The math doesn't work. You can't deliver 60 million ounces in 2 days. The logistics alone are impossible, but more importantly, doing so would drain vaults to critical levels. So what happened? Premiums exploded. The spread between paper futures prices and physical spot prices went parabolic. Paper silver was trading at $79. Physical dealers were quoting $95 to $110 for immediate delivery. That's a $16 to $31 premium over spot. That's not normal markup, that's shortage pricing. The supply reality, 9 and 14 wars. Let's talk about what the Venezuela situation exposed, because the strike didn't create a shortage. It revealed one that's been building for years. According to the Silver Institute's latest data, global silver markets have been in structural deficit for approximately 7 consecutive years. That means annual consumption exceeds annual production. The deficit averaged around 150 to 200 million ounces per year. Not catastrophic, but sustained. And deficits don't solve themselves, they accumulate. Where does that deficit come from? Above ground stockpiles, investment holdings, recycled material, the cushion supply that's supposed to smooth over temporary imbalances. But 7 years of deficits means that cushion is getting thin. Silver mine production has been essentially flat since 2016. According to mining industry reports, primary silver mines produced approximately 200 million ounces in 2024. That's basically unchanged from 2018. Byproduct silver, which comes from copper, zinc, and lead mining, produced around 580 million ounces in 2024. Also basically flat compared to previous years. Total mine supply, approximately 780 million ounces annually. Total demand, approximately 1.2 billion ounces annually. That's a 420 million ounce deficit. And that deficit is covered by above ground stocks, recycling, and strategic releases. But recycling rates are declining. Electronic waste recycling captures only about 18% of silver used in devices. Solar panels lock silver away for 25 to 30 years before potential recycling. Industrial processes are optimizing to use less silver, generating less recyclable waste. According to estimates, recycling added approximately 150 million ounces in 2024. That leaves 270 million ounces that must come from above ground stocks. 7 years of 270 million ounce annual draws equals 1.89 billion ounces drained from global stockpiles. That's not abstract. That's silver that was sitting in vaults, investment holdings, and strategic reserves that's now been consumed. And here's the critical part. Nobody knows exactly how much above-ground silver exists. Estimates range from 2 to 3 billion ounces globally, but those are estimates, not verified inventories. What we do know is visible inventories. COMEX vaults, LBMA vaults, major exchange-traded funds, and those visible inventories have been declining. COMEX registered silver peaked at around 180 million ounces in 2020. By February 2025, it was down to 113 million ounces. That's a 67 million ounce decline. LBMA silver vaults, which service the London market, held approximately 1.1 billion ounces in 2020. By February 2025, approximately 890 million ounces, a 210 million ounce decline. SLV, the largest silver ETF, held 575 million ounces in 2020. By February 2025, approximately 510 million ounces. Visible inventories declining while deficits persist. That's the structural problem the Venezuela strikes exposed. Industrial demand surge, 14 over 1730. Now, let's talk about the demand side. Because while supply has been flat, demand has been accelerating. Solar panel installations doubled from 2020 to 2024, according to industry data. Each megawatt of solar capacity requires approximately 200 to 300 ounces of silver. With global installations hitting record levels, solar demand for silver reached approximately 180 million ounces in 2024. Electric vehicles production increased by roughly 40% year over year in 2024. Each EV uses approximately 3 times more silver than a traditional combustion engine vehicle. EV silver demand hit approximately 90 million ounces in 2024. 5G infrastructure build-out continues accelerating. Each 5G tower uses more silver components than 4G towers. 5G demand added approximately 40 million ounces in 2024. Medical devices, defense systems, AI data centers, all increasing silver consumption. Industrial demand hit approximately 680 million ounces in 2024, projected to reach 750 million ounces in 2025. But here's what makes this critical. Industrial demand is inelastic. That means it doesn't respond to price increases the way investment demand does. If silver goes from $32 to $79, an investor might decide not to buy. But a solar panel manufacturer can't decide not to use silver. The technology requires it. There's no substitute that works as effectively. So industrial buyers will pay whatever price is necessary to secure supply. And when industrial buyers compete with investment buyers and strategic buyers all at once, prices move violently. That's what the Venezuela strikes triggered. A realization that silver isn't just a monetary metal. It's a strategic industrial resource. And supply is much tighter than anyone realized. The current situation, 1730-21. So where are we now? What does the market look like in the wake of this move? As of early March 2025, silver is consolidating in the $72 to $76 range. It pulled back from the $79.18 high, which is normal after such a violent move. But it hasn't collapsed back to $32. Why? Because the fundamentals that drove the spike haven't changed. Venezuela's refining infrastructure is still destroyed. The 18 million ounces per year of cushion supply is still gone. The structural deficit still exists. Industrial demand is still accelerating. And most importantly, the paper market's credibility is damaged. According to dealer reports, physical premiums remain elevated. American Silver Eagles are trading at $12 to $15 over spot. Generic rounds at $8 to $10 over spot. 3 months ago, Eagles were $4 to $6 over spot. Generics were $2 to $3 over spot. That persistent premium tells you something. The physical market is still tight. Dealers are still struggling to source product, and buyers are still willing to pay significant premiums for immediate delivery. Delivery times remain extended. According to reports from major dealers, products that used to ship in 3 days now take 2 to 4 weeks. Some items show 6 to 8 week delays. That's not logistics problems. That's supply constraints. COMEX registered silver has declined further, from 113 million ounces before the strikes to approximately 98 million ounces as of early March, a 15 million ounce decline in 2 weeks. That's significant because registered silver is what's available for delivery against futures contracts. When registered silver declines, while open interest remains high, the squeeze potential increases. Current COMEX open interest sits at approximately 240 million ounces of paper claims, against 98 million ounces of deliverable silver. That's a 2.45 to 1 ratio. If even 50% of open interest demanded delivery, COMEX vaults would be emptied. Now, will that happen? Probably not. Most futures traders don't want physical metal. They want to trade paper price movements. But the Venezuela strikes prove that psychology can shift quickly. And when it does, the paper market structure becomes very fragile. What this means, 21-124s. Let me be clear about something. I'm not telling you to buy or sell anything. I'm not a financial advisor. This is educational analysis of a market event. But I do think it's important to understand what this event revealed about silver markets. First, the gap between paper and physical is real. When stress hits, that gap becomes visible through premiums, delivery delays, and price dislocations. Second, supply is tighter than official narratives suggest. 7 years of deficits have drained cushion stocks. What's left is increasingly concentrated in fewer hands. Third, industrial demand is a floor under prices. Solar, EVs, 5G, AI infrastructure all require silver. That demand doesn't disappear when prices rise. It just gets more expensive. Fourth, geopolitical events can trigger rapid reassessments. The Venezuela strikes weren't primarily about silver, but they exposed silver's strategic importance in ways that changed market psychology. What happens next? That's the question everyone's asking. Some analysts suggest silver consolidates in the $70 to $80 range for months, building a base for another move higher. Others point to historical patterns. In 1980, silver spiked to $49.45, then crashed. In 2011, it hit $48.70, then declined for years. But both of those spikes were driven primarily by investment speculation. The Hunt brothers' squeeze. The post-2008 monetary fear. This spike is different. It's rooted in physical supply constraints and industrial demand. That's a more durable foundation than pure speculation. According to various market analysts, if industrial demand continues accelerating and supply constraints persist, silver could test $100 to $120 by late 2025 or early 2026. But those are projections, not guarantees. Markets don't move in straight lines. Volatility will be extreme. Closing, $24.25. The Venezuela strikes on February 14th, 2025 did something remarkable. They exposed the reality behind silver markets, the gap between paper promises and physical metal, the tightness of supply, the inelasticity of industrial demand. Silver went from $30.50 to $79.18 in 48 hours. That's the fastest move in history. And while prices have pulled back slightly, the fundamentals that drove that spike remain intact. This isn't about one geopolitical event. This is about a market that's been building toward this moment for years. Structural deficits, declining inventories, accelerating industrial consumption. The Venezuela strikes didn't create the crisis, they revealed it. What you do with that information is entirely up to you. But understanding the pattern, seeing the supply constraints, recognizing the gap between paper and physical, that's not speculation, that's observation. History shows us that when physical markets disconnect from paper markets, the physical price eventually wins. It might take months, it might take years, but physics always beats promises. Silver at $79 shocked the world. But when you understand the supply situation, the industrial demand, and the paper market's structure, maybe the real shock is that it took this long. If this analysis showed you a pattern you hadn't seen before, if you understand now why Venezuela matters to silver markets, hit subscribe. Because over the next months, this situation will continue developing. And understanding the mechanics is the difference between seeing what's happening and being blindsided by it. The choice, as always, is yours.